Welcome everybody to today's Intelligent Property Investor Masterclass. Boy, have we had a week. There's lots of stuff to talk about and how it affects property, because that's what this masterclass is all about. The effect that what's going on around us with all the craziness and what it's going to do to property prices, because that'll give you the edge. Because the more intelligent you are about what's going on, the more intelligent decisions you're going to make. The more intelligent decisions you make, the more profits you're going to make. So that's my aim. So let's get into it. Now, if you're listening to me on a podcast, either on iTunes or in Spotify, make sure that at some stage you duck across to my website, iloverealestate.tv, and get all of the charts that I've got here for you, because I know you're going to want to actually have a look at all of them as well. If you're watching me on YouTube or on my website or on my Facebook page, then you'll be seeing them right here. So let's get into it. All right, why are Aussies sitting on a mountain of cash and as we head out of the Delta dip? That's what we're calling this one, apparently, the Delta dip. Well, we'll see how far it dips and how quickly we get out the other side. Why the GDP figures are hiding the seeds to the next property boom, and how that information could actually give you the edge, which is obviously what we want. Why pollies are pushing for open borders, and I'm talking international here as well as state, and why that could send property prices to the moon. Why one group reckons that land prices will double if the government keeps going with one radical thing that they're doing. And it's a bit of a secret there. I'll tell you what that is in a minute. And why this one major bank reckons house prices will soar to over 20% in this year alone. All right, so that's what we're covering this week. Let's get into it. First up, the Delta dip and why it's hiding this mountain of cash. So let's analyze the facts. What is on the other side of the Delta dip? Now, look, the facts are, first of all, one, the June quarter GDP was better than expected. Now, I know June quarter seems a long way away, particularly if you've been in lockdown in New South Wales or Victoria or anywhere else for that matter. It seems ages ago. But we came into this quarter really super strong, and that's going to be important as to what happens thereafter. The fact is that common economists expect that the markets and the economy will bounce back quickly after the Delta dip. Savings are up. That's a fact. You know, all reports showing that savings are at record highs, particularly here in Australia. And people are generally cashing up and sitting on that mountain of cash. So that they are cashed up, they are sitting there, they're not spending it, they're paying down debts. So what are they going to do with it? Now, I know if you're sitting there and you've lost your job and you don't have a mountain of cash, you're going to go, well, that's a load of rubbish. It's actually not. And if you look at the population as a whole, most Australians are very cashed up. Most Australians have still got jobs. Most Australians aren't going out and spending on dinners and coffees and shoes and suits and whatever else they buy. Consequently, that money is being saved. Now, it's also a fact that a large percentage of this money will go into deposits on both investment properties and buying new homes. So let's look historically, first of all. We've only just got the figures for the June quarter. So it's a little bit old because it doesn't show what's happening with the Delta dip and what's happening particularly in New South Wales and Victoria. But you can see here we've had significant GDP growth. The rebound out of the very negative for 2020 was very strong, and we've slowly been slipping back to that, to something of a little bit more normality, which is what you can see there in the rest of the chart. In fact, most of this gain here has actually come from infrastructure, or public infrastructure, and the spending that's going on there. So about 7.4% of it was related to that. So let's have a look at it on a scale over the last few years. Now, this is real GDP and what has happened across the quarters. And you can see the big dip of 2020, and then we came back up again. This is the second dip. This is the second major lot of lockdowns across Australia. So what this is put out by AMP, and what it shows is that they're tipping that the decline for this quarter is going to be about 4% for the September quarter. Now, it's a little bit variable as to where you put this line, the virus trend. This has been put out by the Daily Spot, which shows a different way of talking about the same thing. But you can see the Daily Spot saying that we're actually a little bit under the overall trend. Whereas if you look at the AMP figures, they've measured it on a much, much smaller scale, which is saying we're already at where we should be from trend. We're actually not. Now, obviously, this is their forecast over here, but we're actually not. So I think this is a little bit more accurate. We've got a little bit more to come to get back up to where we perhaps would have been had COVID not happened. But of course, that's speculation. No one's really going to know. But when you look at other things, you look at the companies, are they doing well? And in fact, they are. Yes, the COVID dip affected them, but this is the company profits. They're up here. This is at the end of August, so the figures here are not old. Company profits are up, dividends are up, companies are doing reasonably well across the board. Now, there's some industries, of course, that aren't, and they're the ones that get plastered all over the television, with hospitality and tourism being the major two, and of course education. And the main part of that is because they've lost a lot of the money that used to come in from overseas students. And they're trying to do other things with online learning and other stuff. But the reality is that there's a few industries that make the headlines, but most of the underlying businesses are doing really, really well. So this is just another chart showing the real net national disposable income per capita. So we've actually got more money to spend than we ever have before. I'll just put that on the big screen for you. That shows you, we're way above anywhere we've been right back to 1975. Now, of course, you'd expect that because, we've got inflation and other things. But even comparatively, in the last few years, since 2015, we are massively higher than we were back then, and things were chugging along pretty well back then. The other one, this next chart here shows household savings and the ratio of savings. So whilst we were in lockdown last year, savings went up dramatically. Now, as we got out of lockdown, they started to spend. The next chart here, which will show the next quarter, I believe you're going to see that come back up again because people are locked down, they can't spend their money. So what that means is there's a war chest of money out there in excess of $200 billion. That's how much we are sitting on in our savings. This is individual savings. This isn't government savings, it's individual savings. That's how much we have accumulated. Over $200 billion. Now that's a bucket load of money. And, when you look at the chart here, and we're talking about CBA credit cards and things like that, this was when we started to spend. So we're coming out of lockdown here. We're starting to spend more money. Our credit card balances went up. Now we're back into lockdown again. Look what's happening here. Now, this last little bit is the lockdown, the major lockdown. So, savings, and you show this chart here, and this is a bit of a forecast forward, but it shows that savings are going to come back up again. So what happens when savings go back up? What happens is people put that money into solid investments. Now, part of that is shares, but the most of it is property. People will upgrade their homes. They will spend more money on their homes to get them worth more. They will go out there and spend money on deposits to buy investment properties. All of this pushes up the house prices. So this bubble that people keep talking about is actually a load of rubbish. It's not a bubble at all. It is actually doing a number of things, and one of them is catching up from the pent-up demand that we've had since 2017. If you've been listening to me at all over the last few months and years, you will have realised that I am very negative on what APRA did back then, and it caused an economic slowdown. But we're still chewing through that. We're still getting past those draconian laws that the APRA put in place against the banks. So all of that time we've got pent-up demand, and at the same time, because prices slipped between 2017 and 2019, all the big boys pulled out of the market. And it takes a good 2.5 years to build an apartment block. So they're only just now starting to get back into the market. So the lag time is enormous. It's going to take us a considerable amount of time to chew through all of that pent-up demand. On top of that, you've got kids living at home that are now moving out of home. You've got multi-generational housing that are now getting out into their own place. So there's all of that added pressure that happened all through COVID and everything else. So we've got increased demand, we've got a shortage in supply, we've got massive savings going on, interest rates are very low, and I'll get to that in a minute. Consequently, where are they going to put it? In the housing market. And that's going to further push house prices. Let's look at number 2. Now, number 2 is about opening up the international borders. Again, this has been something that I've been predicting for some time. Well, guess what? It's now here. They're now talking about it. So not only does the federal government want to open up the state borders, obviously got no control over that, the states have, but they do have control over the federal borders, the international borders. And as soon as we hit a target of 70 to 80%, I can bet your bottom dollar we're going to have international travel again. So that's going to be a major thing. The only thing that could disrupt that is if the states get out there and going, but we're not going to take them. We don't want any more planes coming into Australia with their COVID and whatever else. But I think a lot of them have actually indicated that they have to do it because that's the carrot for getting vaccinated. So let's have a look at a few more facts here. The fact is that the pollies are now openly pushing for international travel. They've been secretly doing it for quite some time, as I've said before, but now it's out in the open. The fact is that property market has been incredibly strong despite negative immigration. The fact is that demand is still much greater than supply and likely to remain so for quite some time as we try and chew through things. So the question becomes, what happens when we add immigration on top of our already pretty strong demand? And that's the discussion that's going on right now. International border to open for states hitting vaccine targets. So this is the big carrot. Now, the net long-term arrivals in Australia, as you would probably expect, but this chart just shows it dramatically, is this massive drop here. So we've gone into actually not just very low migration, we've actually gone into negative immigration. More people are leaving Australia than are staying in Australia at the moment. And when you look at where that's happening across the states, you can see here the negative nets. The only one that's actually increasing is Queensland by 3,000 odd. This is for the March quarter, and it's actually even further than that now. If you look at the figures for June, I didn't have them to put in, but I'll show you them next time. And when we get the September figures, that's going to do so even greater because of the second wave of lockdowns. Adelaide's up a bit, Perth's up, and Canberra's up. The rest are all down. They're all experiencing negative population growth, basically. So on international basis, as you can see here, we've actually gone into negative territory across the board. So right across the board, we're into, we're in a depopulation because there's more people leaving than are coming. Now, this chart really shows you what that whole chart of figures showed you there before. The green one is Brisbane. Brisbane is the only one that is actually increasing against Sydney, Melbourne, Brisbane. I haven't got Perth in there because it would show the similar. But it's actually increasing its population. Why? Because of state migration. We've got people leaving, particularly Melbourne, but also Sydney, to move up to Queensland where they've got a little bit more freedom and other things. Nationally, our population, come back a bit. So this is what's happening with the migration. Now that is pushing pricing, but it's pushing pricing both for rental and for property pricing. Now this is a rental chart, and it shows here just how dramatically the rents have gone up for across all of the states. For houses and units not so much, but even Melbourne, which is massively oversupplied in units, has started to come up. So that's a good sign that we're actually getting some decent recovery there. What it also shows, particularly when you look at something like Brisbane here, or maybe even Hobart, possibly Perth. Perth's mainly on the back of the mining industry. But Brisbane and Hobart, what we're seeing there is a lot of people renting, maybe temporarily moving to, say, Queensland, or Hobart, or possibly even Darwin if they work up there. They just need a base so that they don't have this issue of crossing borders. Probably the same thing happening in Perth. You know, they've got a job over there, and you know their homes in some of the eastern states. They're trying to rent something in Perth, so they've got a base to go back to if they can't get back to their families. So it's this lockdown, lock up, lockdown, lock up, lockdown thing that we're going through, which is why a lot of that temporary accommodation is actually being pushed up from a rental perspective. But house prices are also going up. If we look at the change in house prices, you know, some of the banks are going, wow, we're going to get more than 20%. Well, we're nearly there. Nationally, we're sitting at about 18%, but look at the figures. 12 months to 12 months, we've gone, Sydney is already over a 20% growth in the last 12 months. Melbourne is sitting at 13.1, Brisbane is sitting at 18.3, Adelaide is sitting at 17.9, Hobart is sitting at 24.5, Darwin is sitting at 22%, and Canberra is sitting at 22.5%. And the regions are similar. You know, the regions, gosh, the region in Tassie, regional Tassie has gone up 26%. Absolute crazy, crazy figures. So if we then go and add international immigration to that, these figures are going to explode. And this is what I've always said. Prices are going to go up to take effect with all of the stuff that I've been talking about demand and supply and interstate movements and all of these kind of things, population increase and whatever. But then what's going to happen is we will have a lull until we get migration. Well, we may not have a lull at all if international migration hits those kind of targets early next year. I was thinking they'd probably open the borders towards the end of next year. But now that they've made these announcements, I think they're going to bring that forward, which means we're not going to have a lull at all. We're just going to have an absolute skyrocket when it comes to house pricing as soon as those borders come open. Because a lot of people would be rather living here than a lot of other places around the world. Just depends on who and where we let them in from. So number 3, could land prices really double? Well, that's what some industry commentators are actually tipping. And my guess on this is, look, they probably will. And here's why. If you have a look at this chart here, now this chart goes back to 1989. That's the beginning over here. Let me put it on the big screen. 1989. And you can see the land prices. So most of the 90s was relatively flat. Then we had the boom up to 2009 where we had a bit of a GFC jiggle along here. Then we had the boom up to COVID. Now we've had the jiggle along here where we've had a little bit of a drop. But look at the drops compared to the increases. You know, the increase compared to the drop. People keep talking about, oh, the bubble's bursting, the bubble's bursting. Look at the prices are going down. Yeah, but look, even in GFC, they only went down this much. Look at or even if you take that little decline there where it leveled off, look at the decline here with COVID, and now look what they're doing. So whether it's the yellow line or the green line, irrespective, that's what's going to happen. So it's quite likely we could see land prices double. Imagine that. Think about how expensive the finished product is then going to be. And when you combine that with what's happening in interest rates, this came out during the week. There was actually an article done by by ABC, and it was highlighting the fact that interest rates, even though the official interest rate is still sitting at 0.1% with the Reserve Bank of Australia to the banks, banks are coming out and lowering their variable interest rate. So, the fixed interest rate. So fixed interest rate there is sitting at 1.89% for this particular bank. Doesn't really matter which one it is. And the comparison rate was around at 3.97%. So this is for new borrowers. They're trying to attract new borrowers. The RBA has also come out and said that even though they brought the printing of money back from 4 billion a week down to from 5 billion a week down to 4 billion a week, what they've also said is we're going to just extend this until mid-February at least next year, and then we'll assess it again. So they're still promoting the fact that they're going to support this economy all the way to the end. Now, there was a survey done by, research done by Rate City, and they came out with a report that said a number of variable rates are on its database are under 2%. And these have jumped from 28 that were under 2% to 46 that are under 2%. This is also more than 3 times the number of sub 2% variable rates at the start of this year. The cheapest of them was running in at about 1.77%, and the dearest, but the average, was running in at 2.72%. But even so, my God, that's incredibly cheap. We have not seen interest rates like this ever in this country. I mean, this chart goes back to the mid-90s, but ever in this country have we seen interest rates where they are. I remember my first place, I bought at 17% interest, my God. And I wasn't earning that much either. I think my first job out of university was about a $15,000 salary was what I got. So, what this also means is because this bond buying process, the printing of the money, the RBA has said we're going to continue to do this because we're supporting the recovery of the economy and everything else. So this is the big jump here through COVID, and they've had a few pullbacks, and then they've had to put it into place, pull back, put it into place, pull back, put it into place. So, we're still running at very, very high levels of printing of money. And, you start to have a look at what that means. Even the pullbacks that they might be talking about, it's going to make very little difference. I'll put that on the big screen for you. It makes very little difference when you look at the total of how much money we're actually printing, because the little dotted line at the top is not much more than the little dotted line at the bottom. Either way, it doesn't matter. We're still printing a bucket load of money. So that all adds to more money slushing around in the economy. More people have got more money. More people are saving, paying off their credit cards, and they're putting it into property. Now, a lot of that is what the core thinking is with the banks. And ANZ have come out and said that they expect property prices to soar. ANZ have forecast in excess of 20% for this year. Well, no surprises there. They're already at 18, and some of them are already over 20%, so duh. The finance is very strong, so the applications coming through are very, very strong. The banks are still trying to cope with the workload. Lockdown hasn't slowed sales. There's been a little bit in clearance rates and things like that have had a bit of a drop-off, but really, sales generally have dropped, but they're still moving along and they're still selling at record prices, and industry experts continue to expect strong price gains. So this is their chart, and you can see the pale coloured expectations for this year, this calendar year of 2021. The dark blue one here, the navy blue, is what they expect the pricing to be, or the increase in pricing for next calendar year. I actually think they're underblowing it a bit, particularly if we end up opening international borders sometime through next year. The growth rates there are going to be massively more than that, in my opinion. House lending compared to pricing, lots of good indicators here showing that there's still lots and lots of loans going through. The ban on in-person inspections has seen clearance rates drop sharply in Melbourne. So this is Sydney. Not much going on in Sydney, even though they've had the worst lockdowns. Melbourne's the one who've gone, oh, not again. They're just over it. I think they have lockdown fatigue, and that's showing a little bit in the clearance rates. But a lot of that also is the fact that a lot of properties have been withdrawn. So they're just not putting them up to auction because no one can go and see them and all of those things. So when we get back out of lockdown, those are the things that, that'll start to have that little bit of a boost again. We'll start to see clearance rates start to come up again. So despite 2 months of lockdown, Sydney sales remain really, really high. So, they're still well and truly above anywhere we've been previously. Sydney, house prices expectation remain elevated despite the uncertainty, which is what we're seeing here. Compared that right back through to 2009, where we're up there. And property industry participants continue to expect strong house price gains. So this is not reality, this is expectation. And the expectation is that everybody thinks, across the board really, that house prices are going to continue to go up. So it's kind of like a consumer confidence for house pricing. So that's, you start to have a look at expectations. This is what they expect. And again, this only goes up to the June quarter, but really strong figures, which is why ANZ have come out with this lot of data. They put all that together and said, well, this is where we're heading. Now, a little bit of a truth bomb for you for the week. And this really plays into the fact of the house prices and where we're going, and the fact that you can't afford to sit on the couch anymore. You actually need to get out there and be strategic about what you do. There's a lot of rubbish on the market. There's a lot of properties that could hold you back. There's a lot of properties that if you end up buying different types of properties from what is going to really soar in price and give you great yields and positive cash flow that gets you into the next one, the part of your strategic plan, it could tie you up in knots for 5-10 years. Yes, it might go up, but the wrong type of property can really give you some massive headaches. So it's not the time to procrastinate. And I love this little saying here that procrastination is one of the most common and deadliest of diseases, and its toll on success and happiness is heavy. So there is no time to procrastinate. The property market won't wait for you. And that is why I super urge you to take action now. But in your action, I want you to take educated action. So what I've done is I've set aside some 60-minute real estate breakthrough sessions with some of my advisors. They've set some times. There's a click here. You can click through and get yourself an appointment, or you can go to iloverealestate.tv/questions/ and get an appointment. Now, what these appointments are going to do, they're going to talk to you about what we do. They're going to talk to you about how amazing the results have been by getting educated first. I did a boot camp over the weekend, and the comments that have come back from that are absolutely off the charts extraordinary. Because this is where you need to be. You need to be making educated decisions. Now, look, I can give you little snippets of information every week, but you've got to learn the basics. You've got to learn the strategy. You've got to learn tax and asset protection and legals and finance and the ins and outs of how all that stuff works. But you've also got to learn about the business planning side of things. Like, what am I going to do? What does my portfolio need next? How do I combine positive cash flow with growth assets? How do I put myself in a position so every single time, every deal that I do puts me in a better position to get out there and get into the next one? Because that's what you need to be doing to maximize what's going on right now. So your next step from here today, don't do the dilly-dally, is to jump on iloverealestate.tv/questions/ get yourself an appointment. They're free. They're about 60 minutes long. And, we can talk about your movement forward and how you can get yourself educated to move forward to know what to do. So that's it from me this week. I hope you enjoyed my masterclass of the week. And I will be back again to talk to you next week about what's going on and what's, where the opportunities are. So I'll catch you again, guys. Bye now.